Mark Sherwood from iPartners is standing by via Skype with some alternate investment opportunities out there. Mark, welcome back to the program. Look, to go kick off with really quickly, the Federal Reserve last night really created a big move in markets. What do you make of it?
I actually thought the reaction to the Fed's movement was fairly muted, David. Given that clearly they've moved into a much slower rate of increases to rates. Clearly, it shows the markets were fully anticipating only 25 basis points. But I was actually a little bit surprised at the lack of volatility compared to what we've seen. And maybe it's a bit of a function of how strongly listed markets have started the year. People want to wait and see now. Really, obviously, concerns around how much the US economy is going to slow, concerns around most major developed economies and how much they're going to slow. So I think listed markets might move towards a bit of a wait and see approach now. Obviously, closely watching inflation data and see how these smaller central bank movements start to play out.
What we're seeing also is that bond yields are starting to go and sink around the world, and term deposit rates here locally as well haven't really caught up with the other tightening cycle we're seeing from the RBA, which means that for those investors who are trying to go in position for potential pullback in these inflationary pressures and some more safer, more stable investments, what are some of the areas in the private markets right now that you could go and point to as offering decent opportunity?
Yeah, it's an interesting point, David. One thing we've really noticed is that the shorter term deposits, if you look at sort of 1, 2, 3 month term deposits, they've stayed remarkably low given we've got a cash rate of 3.1%. When I look across major bank term deposits, they seem to be kind of between 1.5% and 2% for a 3 month rate when we've got a cash rate that's well above that. So yeah, to sort of counter that to some extent, we just recently launched a conservative fund, really for the purpose of investors that are willing to take a little bit more risk, but they're looking for an investment opportunity that has very strong liquidity terms. So that particular fund has liquidity twice a month. So it's obviously not a government guaranteed term deposit by any means. However, it does hold some cash and it does hold some deposits within the fund, and then it obviously will hold some private credit, some very high grade private credit, and that's where the yield gets a slightly stronger outcome. So I think definitely the private markets are coming up with ways to help investors who kind of want very strong liquidity terms, but are happy to take a little bit more risk and get a return in an environment where they probably don't want to necessarily lock into a slightly better term deposit rate where they've got to go out 6 or 12 months to achieve that.
When you say conservative, what kind of yield can you expect to go and get on your investment?
Yeah, we're targeting around the 3 to 3.5% yield on that kind of solution. So it's obviously a very high grade type of solution. So you're kind of achieving that kind of yield at that 3 to 4% type range. However, you're not locked in for 3 months, and you're actually receiving twice monthly distributions. So we're trying to solve for that investor demand of high liquidity terms a couple of times a month, and also receiving your distributions really frequently a couple of times a month for investors that want to stay very short term in their investment approach.
No, that's good to know. Well, look, one thing I'm going to go and finish off with is talking about property-linked investments at the moment, particularly in the tourism-related space, because we're seeing that the listed tourism players in the local market have been absolutely flying recently. When you go and look at the private market opportunities, conceivably there should be a lot of opportunities out there. How is that looking at this point in time?
Yeah, that's definitely a place where we're active. We were very active last year, I would say, in sort of regional hotel opportunities, and that's played out very well. You've seen a lot of publicity around the increased values in pub style assets. We've also turned our focus towards regional accommodation opportunities, which speaks to your comment, David, and that is particularly where in an environment where some of the operators of regional motel accommodation, largely mums and dads mostly, have gone through a very difficult couple of years. They've obviously gone through COVID lockdowns, COVID reopening, and some of these kind of owner operators are probably just looking to move on and take some money off the table and potentially sell their asset. So that's definitely a place in the private markets where we see quite a unique opportunity. It's a unique opportunity because we can take exposure to the operating company, that is the motel itself, and also own the land. So there's some potential land appreciation over the longer period as well. So that regional accommodation is definitely an interesting opportunity for the alternative investor.